Hey everyone, Joe Stanovec here. So we're going to expand on life insurance. So last week we talked about the difference between whole life and term life insurance. This week I'm going to drill down more into term life and give you kind of a case study briefly, like, how much to help you determine how much life insurance you need. So remember, the whole point of life insurance is to insure against an unexpected death. I will say from personal experience that having some financial flexibility after the unexpected death of a loved one, specifically a spouse, can truly be life-changing. It's obviously already jarring enough to unexpectedly lose your spouse. But then if you throw on that financial stress, if you have kids, the possibility of having to move, relocate your kids when they've already lost their parent, and anything that you can do to keep things kind of status quo beyond obviously not having your partner to help raise your kids, the better for your own mental health and for your kids' mental health. So that's where life insurance, specifically term life, can be extremely, extremely beneficial, especially because it's so cheap. Okay, so let's go through a case study so you can kind of see what kind of thought process you should consider when determining how much term life insurance you need. So I am not gonna hit on every single specific input to like the whole entire formula to determine how much term life you need, because I'm not gonna factor in group term life insurance. That's a whole nother video that I can do by itself, or like other liquid assets that you may have, like a brokerage account, things of that nature. If I did that, this video would be twice as long as it's already probably gonna be. So I'm gonna try to keep it basic. All right, so here we go. We have John and Jane Doe. John and Jane are in their mid-30s. They have thriving careers. They have 2 young kids. They're middle class, okay? 2 young kids, they have a mortgage, they have some student loan debt. That's a whole nother video too. There's so much to talk about. Some student loan debt. They have, goals of sending their kids to college. They have goals of retirement. And so yeah, pretty good case here. So let's just say John and Jane wanted to make sure that the other spouse, like a surviving spouse, had some financial flexibility if somebody passed away. So they have the mortgage. So the first thing you'd want to try to do potentially is pay off the mortgage if somebody died. Life insurance is a great way to be able to do that. So that right there is $750,000 need of life insurance. Yes, I know the mortgage principal will be paid down over time, but just bear with me, okay? So $750,000 right there, plus the student loan debt of $50,000. You wanna pay that off too? This just provides flexibility for cash flow for the survivor, right? So there's $800,000 right there in life insurance need. Wall Street Journal comes out with a study every year, and this is kind of depressing, especially I have 3 kids, and when I see these studies, you just kind of, because, but what they do is they kind of have studies that give you an idea on average how much it costs to raise a kid from birth to age 18. And the last study I saw, which was probably about a year ago, it was up to $270,000. $270,000 from birth to 18, not including college. So they have 2 kids, 4 and 2. So let's just say the survivor wants to be able to just have some flexibility, raise the kids, put them in sports, nanny, childcare, whatever. So let's say we need another $200,000 each. So there's another $400,000 total on top of the $800,000 that we already needed for the debt. So there's $1.2 million, okay? So Jane and John will have goals to fund their kids' college education. Let's say they're gonna try to, assume that they're gonna go to Cal Poly San Luis Obispo. Right now, Cal Poly San Luis Obispo, when you include tuition and room and board, is basically $30,000 a year if you're a California resident. And these kids are young, 2 and 4. So by the time they are actually college age, Cal Poly SLO may be 150,000 because of inflation. So if we wanted to fully fund that future expected cost with life insurance, you may need to fund with about $100,000 into a college savings account today, and see that money grow over the next, I guess, 14 to 16 years, or maybe even a little bit longer, to get to the point where you have about $150,000 available for college. So basically you have life insurance to fund the future cost of education for your kids. So in today's dollars, to fund that future cost, let's say it's $100,000 each. So you have $100,000 for each kid, plus the $400 for just raising them, and then you have the $800 for the debt. So $800 plus $200 per kid, so that's 1.2, plus another $200,000 for the college, so that's 1.4 million. So Jane, let's say John passed away. I'm almost done. Let's say John passed away unexpectedly. Jane has a pretty demanding career. She's got to travel every now and then. Obviously, if your spouse passes away, the last thing you're going to want to do is leave your kids. So what if Jane wanted to have some financial flexibility with her career? Maybe she wanted to step back significantly from work. Heck, maybe she wanted to stop working altogether for a couple of years while she manages the household by herself, So you need some cash flow to help replace John's income on top of all that other stuff. So let's say they're spending, outside of the debt and everything, is $6,000 a month. And you divide that by 2. So let's just say $3,000 a month is John's contribution, right? In terms of the month to the monthly spend. So let's say you want to fund 20 years of the $3,000 a month of expenses, basically be able to replace that. So if you said $3,000 a month today times, or say 10 years, 20 years is too long. So say 10 years to keep the math simpler. So $3,000 a month for 10 years. If you do the math on that, that's 36,000 times 10, that's $360,000. So you add that basically replaces some of the income or pays some of the expenses. So that right there, you're already at 1.75 million. And we haven't even considered, how long Jane may want to not work, how much John's salary was. Maybe John was making more or vice versa. There's so many other factors and variables that go into it. This is basically just like a really back of the napkin, but already with that, you're 1.75 million. So last thing, with term life insurance, what's beautiful about it is you don't necessarily have to, in this case, you don't have to take out a 1.75 million 30-year term life insurance policy. What I talk to clients about with this is they, say, the kids are 4 and 2. So 20 years from now, they are going to be basically about done with school, college. So maybe what you do is you do a 20-year $1 million term life insurance policy and a 30-year $750,000 life insurance policy, or vice versa, because the expenses, obviously 21 years from now, aren't going to be as high as they are now, because the kids are going to be, entering adulthood. They'll probably be done or just about done with school. So those goals are funded. So you don't need life insurance on the front end to fund those goals, because they've already been accomplished. And then if John unfortunately passed away in 21 years after the $1 million term life insurance expired, you still have $750,000 available to cover maybe leftover debt, the mortgage, and some living expenses. But you don't necessarily need the $1 million for the college funding and raising the kids and all that. So over time, your life insurance need does decrease if you are paying down debt and growing your assets. So I know those were a lot of numbers, and I know that's, it takes a minute to digest, but ultimately it's very dependent upon you. So if you're being pushed life insurance, and especially if it's anything but term, like I said in my last video, run or call me and say, hey, so-and-so is saying I need this whole life insurance or I need $5 million of term life insurance. Some people say, hey, call the insurance company and ask them, how much life insurance are you willing to write on me? And that is kind of a good way to look at it in a way and say, because at the end of the day, I know for me, I want my wife to be taken care of if something happened to me. I don't want her to have to worry about money. I want her to have to, she's already gonna have enough to worry about. The last thing I want her to do is have to worry about money and having to sell a house and uproot the kids. So sorry to be depressing again, but this is such an important topic and I'm very passionate about it. So if you have questions about life insurance, how much you need, want to get some idea of how much it costs, reach out. Happy to help. Don't forget to subscribe to my channel. I did it again. I forgot to say it at the beginning of the video. Subscribe to my YouTube channel. Take care. Have a great day.